Oil prices are edging higher as OPEC plus countries left their output quotas unchanged today. For more on the energy market and some stock picks, let's go to Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Rob, thanks for joining us. OPEC didn't make any changes, but I know they're expected to up output in July. What do you foresee for prices for oil?
Yeah, so if OPEC continues to increase and add supply to the oil markets, we expect that oil prices actually will probably fall because the market will be oversupplied. There'll be more oil out on the market than what's currently being demanded, and that actually is not a bad thing for consumers. Gasoline prices will likely fall in the U.S. and Canada as well, and that will be a positive during this the summer driving season.
Okay, so we know there's a meeting on Saturday as well for OPEC. What will get decided there?
Well, that will be the decision will be what will July production be, and will they add additional volumes back to the market? And the expectation is they'll add another 411,000 barrels a day back to the global oil markets, which will basically increase the amount of oversupply that the current market has. Now, the U.S. producers are already adjusting. You know, the rig count in the U.S. is down. The U.S. producers are likely to slow their production growth. If not even go to flat production growth very soon. And that will help balance the market. And then longer term, we think that oil prices will recover and be in the $60 to $80 range in the longer term.
That being said, Donald Trump, as we know, likes oil. He likes the sector. He wants more oil popped out of the ground in the U.S. Do you see that being any sort of material gain to oil anytime soon?
Well, I think the administration, I think the American consumer likes lower gasoline prices more than they like more oil. And so if the oil price, for oil prices to stay low, I think they can stay where they are at the current levels. And gasoline prices can come down. I think it'll take a while before we see substantially higher oil prices because the oil and gas producers in the U.S. are going to be very disciplined. They've learned their lesson over the years. In my years of studying and investing in the energy sector, which is now almost 30, the sector has become very disciplined just really in the last 4 or 5 years. And I don't see that changing. Investors are rewarding it. Producers are embracing it. And so as a result of that, I do think that the producers will not raise oil production anytime soon.
Let me ask you also about AI and AI build out and how much you think that energy will benefit from that.
Yeah, this is a huge opportunity for the energy sector. It's for the first time in my career where the energy sector and technology sector really are going to advance side by side. And so if you listen to what's going on in technology, there's a lot of great things going on with AI, but none of that happens without energy and electricity. So electricity demand is going to grow significantly over the next several decades. Keep in mind, it's not grown at all in the last 2 decades, but it's going to grow a lot in the next several decades. And so you've got to look at the value chain and say, well, where's that electricity growth going to come from? What are the fuel supplies going to be to really support that growth? And so natural gas, nuclear, those two are going to be really important fuel supplies to generate this significant amount of electricity that's absolutely essential for AI to continue to develop.
Okay, let's talk a little bit about your stock picks. We do have one energy stock here that you're talking about. So let's get into the first one, which is first Williams Company, then we'll do Energy Transfer.
Sure. So Williams is the classic example, one of the largest pipeline networks related to natural gas, transporting natural gas in the U.S. You know, if you think about Williams, you think about economic moats that Warren Buffett likes to talk about. It's impossible to replicate this pipeline network that Williams really has, and a lot of these energy infrastructure companies has about a 3% dividend yield. I think where people are going to get surprised here in a positive way is I think the growth out of the cash flow and ultimately the growth out of the dividend will be higher than what people are expecting. And then Williams is right in the center of this AI trade, of providing the natural gas that generates the electricity that really is that AI needs to continue to develop.
Okay, let's get to Energy Transfer. Tell me about them.
Quickly, Energy Transfer is a 7% dividend yield. It's going to grow its dividend 3 to 5% a year. So high dividend income for your viewers that are looking for a lot of dividend income and cash income. The thing about Energy Transfer, it's got a diverse network of infrastructure assets. Once again, very difficult and almost impossible to replicate this network, but it benefits from AI, but it also benefits from energy exports. And that's the other thing, that the other big theme, exporting energy, not just liquefied natural gas, not just oil, but things like ethane and propane and gasoline. And Energy Transfer has some really, and operates some really critical assets that really participate in all exports of U.S. energy products.
Rob, I've got to leave it there with you. I'm out of time. Rob Thummel is a senior portfolio manager at Tortoise Capital. Thanks for joining us.